The next type of bond I'll be discussing are agency bonds, which are backed by the US government or government-sponsored enterprises. And they can also issue bonds for their own purposes, such as like housing. During the financial crisis, you may have heard of a couple companies, one called Ginnie Mac, which stands for the Government National Mortgage Association, and they are backed by the US government, or another company called Freddie Mac, which stands for the Federal Home Loan Mortgage Corporation, and they aren't backed by the US government, so it's a government-sponsored enterprise, or a GSE for short. So these bonds pay interest semi-annually and have different investment levels. The first investment level is going to usually be about $10,000, and then from there on out, it's going to be in increments of $5,000. So continuing, the next one is a mortgage-backed security, or MBS, and you may have also heard of these back during the financial crisis. And mortgage-backed securities are backed by real estate and home loans, and these loans are usually pulled together and sold either by a GSE, like I just went over, or to a securities firm. A couple differences with mortgage-backed securities as opposed to the other investments I previously went over. One of them is that interest accrues monthly on mortgage-backed securities as opposed to the other ones. That's because homeowners have a mortgage that they have to pay monthly, obviously. And another big difference is that with U.S. Treasuries, for instance, you get a coupon payment, whether like semi-annually, interest payment, and then you get your principal back at the end. With mortgage-backed securities, part of your payment back to you is the principal. Now, you may be wondering, what does that mean? So you get the interest, you get a nice chunk of interest at first, and that interest dwindles, and you get some of your principal back. So that just means that you won't get a lump sum payment like the other bonds. Now, some people like that, some people don't. They know they're getting their principal back, as opposed to, oh my God, what happens at the end if I can't? Yeah, you have that security with that. But mortgage-backed securities aren't quite as safe generally as like a treasury. Then lastly, the minimum investment varies, but generally they're going to start around $10,000. Next one I want to go into quickly are international and emerging market bonds. And international bonds can be purchased from different countries, and the interest rates on these are probably going to be different depending on the country you go to. And they also usually pay a semi or annual interest. One of the many differences in risks with internationals is that these bonds, compared to the US, you're going to be receiving a different form of currency, or at least you may be getting a different form of currency. And then when the bond pays interest or you sell, you have to take cash received in that form of their currency and then convert it into dollars. So this could increase or decrease your investment depending on how strong that currency is relative to the dollar. And then some other risks are, political, economic, and cultural differences that make up the sovereign risk associated with that country. And again, depending on the country, depending on the time, who knows what those risks could be, and you definitely are going to want to do your own research on those countries long before you start investing. Not that you shouldn't with other investments, but this is a bit different where bonds here, depending on what they are, like a treasury, are backed by us as opposed to their own country. And then usually these bonds have a minimum investment of about $1,000. So now to everybody's favorite, corporate bonds. Corporate bonds are issued by different companies for a variety of different reasons. So companies can offer these bonds because they need money from some sort of expenditure or operation that they have coming up. And these bonds can make different types of interest payments in different time frames. Also, their maturities can range from 1 to 30 years. So this is where I would say either the first or second type of bond people think of, at least here in the United States. So corporate bondholders don't own any equity in a company, and they don't have voting rights similarly to a stock owner, let's say. However, if the company goes into bankruptcy, the bondholders are more likely to get some of their investment back, potentially all of it, depending on how bad the situation is. Now, again, remember to do your research on the company so you don't have to worry about this, and you can check, again, if they're investment grade or not. And that doesn't mean that if a company is of investment grade that they can't go bankrupt. So please don't ever think that. Now, there are a couple different classifications when it comes to bonds, and you're going to want to know this because if a company can't pay its obligations and does have to go into bankruptcy, you're going to want to know what you're getting paid and what level on the totem pole you are. So the first type is called secured corporates or senior secured debt. And you may have guessed it, they are first on the totem pole if a company does go bankrupt to get at least some of their money back. Now, these instruments are backed by like an asset that the company owns or some form of collateral that if the company has to sell it to pay back the debt, you know that there is a possibility that that can happen. And again, you're first on that. The second one is junior bonds or unsecured debt or debentures. You may hear any one of those three depending on who you're talking to. And they all pretty much mean the same thing, that these bonds aren't secured by any assets or collateral, that they're only backed by the good credit of the bond issuer. So we just have a couple more, and they are called guaranteed and insured bonds. And guaranteed bonds have a third party agreeing to pay their interest and principal if the issuing company can't make these payments. Now, remember, if you're going to invest in these, the guarantees are only as good as the credit worthiness of the company who's making that guarantee. So you're going to want to do your research into both those type of companies. Lastly, we have convertibles, and convertibles offer holders an option to turn that bond into shares of common stock at a pre-established price regardless of what the current price is. So that can help you, it can hurt you depending on what the price is and then what the price you agreed to is. And the minimum investment for these are usually $1,000. So thank you guys for watching my first of many videos. If you have any questions, please feel free to let me know at any time and I will get back to you as soon as I can. Take care, guys.